Collapse file number 21. Subject: JPMorgan Chase, the largest bank in America, and one quiet office inside it, built for a single purpose: keeping the money safe. Position at time of death: $157 billion. Discovered by the traders hunting it. Cause of death: a position with no exit. This is the collapse files. In the spring of 2012, hedge funds in London noticed something enormous moving beneath the credit markets. They could not see it. They could only see the water it displaced. So they named it before they ever learned what it was. They called it the London Whale. 2012. JPMorgan Chase is the bank that won. It sailed through the financial crisis without a single losing quarter, swallowed 2 failing rivals on the way down, and its chief executive, Jamie Dimon, is the closest thing Wall Street has to a king. The fortress balance sheet, his phrase, and for once, the market believed it. Deep inside the fortress sits the chief investment office. Its job is not to gamble. It manages the bank's spare cash, more than $300 billion in deposits the bank has not lent out, and parks it somewhere safe. Think of it as the bank's airbag. One corner of that office in London runs something called the Synthetic Credit Portfolio, a book of credit derivatives, insurance contracts on the debts of big corporations. If a wave of companies fails, the contracts pay out and cushion the bank's losses. Insurance, that is the theory. And the theory worked. In November 2011, American Airlines filed for bankruptcy, and the London book collected roughly $400 million on its insurance. The airbag deployed exactly as designed. It would never work again. The trader running the book is Bruno Ixel, French, methodical, a quant who commutes in from Paris on Mondays and goes home to his family on weekends. No yacht, no headlines. In January 2012, his orders change. New capital rules are coming, and the book must shrink. But shrinking costs money. Selling positions means paying the market to take them. So the desk chose the clever route, the fatal route. Instead of selling the insurance it owned, it would sell other insurance against it, stacking new bets on top of old ones until, on paper, the risks cancelled out. In a single quarter, the book tripled from $51 billion of exposure to $157 billion. The hedge was now larger than the thing it was meant to hedge. The airbag had become the car. And out in the market, the arithmetic started to show. One credit index, a dusty pre-crisis contract called IG9, began trading out of line with the sum of its parts, day after day. To a hedge fund, a mispriced index means exactly one thing: somebody very large is leaning on it. The funds bought the cheap index and waited. They had worked out the one fact that mattered, the fact JPMorgan itself had not yet accepted. Whoever was on the other side was too big to leave. Every attempt to exit would move the price against him. The whale was not swimming, it was beached. At a charity investment conference in Manhattan that February, a fund manager named Bose Weinstein stood up and recommended the trade to a ballroom full of rivals. Buy the index. He did not know who was on the other side, only that someone kept selling at a price that made no sense. The hunt was public now. Through February and March, the London book bled. Not catastrophically, quietly. 100 million here, 100 million there. And with the losses came a second game played inside the desk itself, the game of deciding what the positions were worth. Derivatives do not close at a neat price like a stock. They trade in a range, and the desk gets to mark where in the range its book sits. Day after day, the marks crept toward the flattering edge. The junior trader kept a private spreadsheet tracking the gap between the desk's marks and the middle of the market. Over 5 days in March, by that spreadsheet's own arithmetic, the gap passed $400 million. On a recorded line, Ixel told a colleague the situation was becoming, in his word, idiotic. The Senate would later print the transcripts. Inside the desk, by the Senate's account, Ixel himself had been telling his bosses for weeks that the position had grown monstrous, that the sane move was to take the loss and get out. The instruction that came back, in effect, defend it. The risk systems noticed. In January, the book breached the bank's value at risk limit, the number meant to cap how much the entire firm could lose in a day, 4 days running. The breach went all the way to the top. According to the Senate record, Dimon approved a temporary raise of the limit by email. One line, "I approve." And then the problem vanished. Not the risk, the number. On January 30th, the desk switched on a new risk model, and overnight, the book's measured risk fell by roughly half. Nothing had been sold. Nothing had changed but the mathematics. Remember that model. It is about to become one of the most expensive spreadsheets ever built. On April 6th, Bloomberg and the Wall Street Journal found the whale. Front-page stories described a JPMorgan trader in London whose positions were so large they were distorting entire indices. The bank had a week to prepare its answer. That answer is Exhibit O of this file. April 13th, 2012. The quarterly earnings call. Jamie Dimon, asked about the London reports, dismisses them in 6 words, a complete tempest in a teapot. By the Senate's later accounting, the book was already more than $1 billion underwater. The teapot was 150 billion wide. Exhibit B arrived 9 months later, buried in the bank's own post-mortem. That new risk model, the one that halved the book's danger overnight, was a chain of Excel spreadsheets, updated by hand, numbers copied and pasted from one sheet into the next. And inside it, the reviewers found a formula error. At one step, the model subtracted an old rate from a new one and then divided by their sum instead of their average. The bank's own report put it exactly that plainly. The slip muted volatility by roughly half. The riskiest book in the firm was being graded by arithmetic that cut its danger in two. A $6 billion trading loss at the largest bank in America, with a spreadsheet typo sitting in the chain of causation. The fortress was guarded, in part, by Excel. On May 10th, Dimon reversed himself before the world's press. The strategy, in his words now, was flawed, complex, poorly reviewed, poorly executed, and poorly monitored. $2 billion was gone, and he conceded the number was still moving. The stock shed billions in market value overnight. Because here is the cruelty of a position with no exit. Announcing it makes it worse. Now every fund on earth knew the size of the wound and that the seller had no choice but to keep selling. The loss climbed through the summer like a tide. 2 billion, 4.4 by July, 6.2 by the end of the year. In July, the bank did something almost unheard of. It restated its first quarter earnings, conceding the London marks could no longer be considered good faith. The junior trader's private spreadsheet, the gap ledger, became evidence. Ina Drew, the head of the chief investment office and one of the most senior women on Wall Street, retired within days of the May announcement. The London desk was dismantled. The bank clawed back years of pay. In March 2013, the Senate's investigators published 300 pages on the whale trades, hidden losses, ignored limits, a risk model that failed on arrival, and statements to investors the report called inaccurate. The bank disputed parts of it. It paid all the same. The examiners at the bank's own regulator, the OCC, learned the true size of the portfolio from the newspapers. The Senate found the bank had quietly stopped sending the reports that would have shown it and brushed off the questions when they came. September 2013, $920 million in fines paid to 4 regulators on 2 continents. And, rarer than the money, a formal admission of violating securities law. The 2 indicted traders, Ixel's supervisor and his junior, stayed in Spain and France and never saw an American courtroom. In 2017, prosecutors gave up. Their star cooperator's account, they conceded, could no longer be relied upon. The charges died quietly. Bruno Ixel, the London whale himself, cooperated, was never charged, and has spent the years since insisting he was the one who warned them. The Senate transcripts in places back him up. Now the tally, and it is the strangest one in this series. Jamie Dimon kept his job, his board halved his pay to $11.5 million, and JPMorgan closed 2012, the year of the whale, with a record profit, $21.3 billion. That is what makes this file different. File number 2, Bearings, died of a wound exactly this shape. The whale's $6 billion barely slowed the Leviathan carrying it. The biggest trading loss in the modern history of American banking is, today, a footnote, because the ship it hit was too big to sink. Almost nobody went to prison. Nobody, in fact. File 21 closed.